Hi, everyone. Welcome to the new week. So today we're going to continue with the next strategy. Article 16, Event-Driven Strategy. So first one, let's talk about definition. Event-driven strategy is a strategy to find profits from misestimating companies' prices at major events such as mergers and acquisitions, bankruptcy, share buyback, capital restructuring, extraordinary dividend payments. Investors will study their circumstances and assess how they will impact the company's stock price. They identify potential opportunities that may arise and take advantage of them. The strategy's effectiveness depends greatly on the investor's ability to capture information, analyze, and evaluate. More recently, the event-driven strategy has also included pricing after major global macro changes or natural disaster in different regions. So let's talk about example of event-driven strategies in mergers and acquisitions. Arbitrage trading involves mergers and acquisitions (M&A) activities is one of the popular examples of an event-driven strategy. Hypothetical scenario, merger and acquisition with cash payments. Buyers propose buying shares of a target company at a fair price, bid price, and the price is higher than the market price. Trading strategy, if you believe that the deal will go on as announced, you will buy the shares of the target company and sell when the deal closes. So in order to know more, you will see the figure 5 event-driven strategy of merger and acquisition. So now let's give an example of event-driven strategy in a global macro event. As the Russia and Ukraine wars continues to drag on, investors who have information that Russia and Ukraine are major wheat exporters in the world will see a short-term decline in supply. It creates an upward demand for wheat and rye producers. Investors can take advantage of this opportunity to make a profit. The positive stock movement of Vietnam National Seed Group, holds NSC, in the market downtrend may have partly reflected this event. As you can see in figure 6, the Vietnam National Seed Group stock price during Russia and Ukraine war 2022. So now let's talk about event-driven strategic risk. Incorrect pricing of the event impact is the most common cause of losses for investors using this strategy. In addition, a less common but potential huge cause of losses is third-party interference. In an event-driven strategy, third parties can be very powerful organizations such as the US or Chinese governments. Action that can change an investor's entire calculation include policy changes, releases of the strategic reverses, embargoes, etc. In addition, there are unexpected internal events. For example, M&A events cannot take place due to a few reasons. Shareholders of the target company do not approve, and the Security and Exchange Commission does approve and does not grant licenses. Another example is that the deal got approved, yet needed time for the completion of the legal procedures. When the shares got converted and allowed to trade, the price fell again and investor no longer made profits. So that is the end of the next strategy for today, which is event-driven strategy. I will see you tomorrow and read about the next strategy, market making strategy. Goodbye and see you.